Good morning, folks. How you doing today? First and foremost, I want to let you know that I am not feeling great. My energy level, my throats, it's all a mess. So we're going to get through the daily financial news because that is what we do, but I just don't have my normal energy. So I apologize. I figure it is a great thing to keep the streak going. Plus, I've done all the research, so let's talk about what is going on today. We need to talk about the dot plot, the summary of economic indicators. That is going to be the most important thing on Wednesday, is my belief. We'll talk about that. We'll talk about the Austin housing market, why Austin is acting very different this time versus the Great Recession. Is that an indicator of what might be coming? We can talk about the first day of my boot camp and the lessons I hope all of you would take from it if you were a part of it. So folks, let's just get into it. I'm kind of fuzzy up here, so I don't actually remember everything. That's why I have notes today. So the dot plot. Wednesday, we will get the Fed pause, in my opinion. We will get a hawkish pause from Powell. He will talk tough. He will flex his muscles. He'll say blah, blah, blah. It's all talk, in my opinion. It is the dot plot that we must watch. What is the dot plot? It is basically the summary of 18 opinions across a wide range of things. The ones that I will be looking for: GDP growth. Where do they see GDP growth going over the next 12 months? Terminal rate. Where does the terminal rate go? How many of them see another rate increase or two? We will look at that. Unemployment. Does any of them see unemployment going over 4.5%, 5%? And these are the things that will be important to me because, again, these 18 individuals and their forward projections are what I think all of us should be paying attention to. So I will definitely be looking at that. All the other stuff around Wednesday's release I think are fairly well known. Pause, hawkish pause, all of that. So the dot plot will be the most eye-opening. And again, for me, it will not only be the dot plot, but what changed from 90 days ago. They do this summary of economic indicators once every 90 days. So we can watch how their opinions change. So those are the things that I will be looking for. So that's what Wednesday is going to be all about. How about inflation? Could inflation be over? I want to bring you an insight into how inflation is defeated, and we are going to use airlines as an example. Ask yourself, what happened last year when airlines had excessive demand? If you don't remember, they raised prices. Remember this? All the airlines, or at least most of the airlines in the last 2 weeks, United, American, Southwest, Delta, and many others, have come out with profit warnings, earnings per share. What are they saying? Costs are going up. Now, if we were still in a raging inflation battle, what would airlines do? Airlines would raise prices to the end customers. What did they just do? They warned they are going to eat margin, aka not pass on higher prices to end consumer. Because remember, Southwest Airline about 10 days ago warned that August bookings were below expectations. So demand softening, costs rising, they are eating margin. Lots of folks expect, hey, costs are going up, they're going to pass it through. Folks, that game is over. We actually heard it from Kroger's, a grocery store, that they are having to eat margin because the consumer is stretched. So these are all early signs that disinflation may be picking up, and in some cases, we may have outright deflation. In fact, if you follow me on Twitter, One Rental at a Time, I shared a tweet this morning with somebody that expects shelter by the end of Q2 2024 to be deflationary. Yes, folks, there are people calling the slowdown in shelter, which you and I have been talking about for a year. They are calling the slowdown so hard that we will have shelter deflation. Inflation, disinflation, deflation. Inflation, 9%. Disinflation, 3 versus 9. Deflation, negative numbers. Negative. So we shall see. And again, we have student loan debts. We have a government shutdown. We have strikes. All kinds of mess going on here in September. So again, watch the signs. A lot of folks think that, again, when costs go up, they pass prices because that's what we've suffered the last 2 years. It's not how it normally works. Just look at the airlines as one example of how margin could be sacrificed instead of raising prices. How about this quote? This came from Nikki Leaks. Yes, full credit to Meet Kevin for that nickname. Nikki Leaks on Twitter kind of has an inside track to the Fed. He put out a tweet this morning, or at least I saw it this morning, that says, planes land, economies don't. And of course, what Nikki Leaks is talking about is, hey, there is always hope for a soft landing, but most of the time it goes unrewarded. In fact, he posted a chart with how many times articles had referenced soft landing going back to the 1990s. And again, you're seeing a lot of folks talk about a soft landing now. Again, no idea. I still think a recession is more likely than not. In fact, with higher rates and shutdown and strikes and student loans, I'm not sure how you get through this without negative GDP growth, but we shall see going forward. I thought that was very interesting. And then minority mindset. Jaspreet Singh. Wow, my throat. Oh, not good. Looks like he's calling a recession starting in Q2 of 2024. He thinks the U.S. economy will hit a wall. I think that's as good a guess as any. He is recommending folks start saving. Start stacking dry powder. Remember our conversation with Danielle DiMartino Booth. I asked her, Danielle, scary headlines coming. What is the average American household supposed to do? And she talked about what she is having her kids do. Right today, you can get 4 or 5% just saving money. So again, if you want to take action, you want to take advantage of where there is pain, you have to have dry powder, access to dry powder, and the knowledge to know what a great deal is. Because where there is great pain, there is great opportunity. I suggest not being the person who is in pain, but instead being the one that is ready to strike when the opportunity is out there. Austin, I think one of the things that a lot of new real estate investors should do is they should look at Austin real estate a la 2023 and Austin real estate a la 2010. I don't know if you know this, but in the great housing crash, Texas real estate, Austin specifically, didn't fare that bad. When you have a lot of housing bears and crash folks and all of this talking about housing, I asked them to go back and look at Austin compared to Fresno, California. Fresno, California went down 75%. 70%. Some of my houses, not the entire market. I think the market was down about 60%. Austin was down like 8, 9, 10, 11%. Why is that? Why is that? How could Austin be down, let's call it 10%, where Fresno was down 70%? Answer, last time it was the debt. It was the debt. Texas had some regulation and rules that didn't allow the toxic, the frankly now illegal loan products that were sold pushed, sold, given in the last crisis. Hence, it didn't have a lot of pain. What is happening now, though? Austin is the poster child of housing pain today. I think it's down 11 or 12% already and going lower. Why is that? Why is that? I have my opinions. I've never bought in Texas. I don't own in Texas. I've looked there. I passed, but what is going on? If you invest in Texas, let me know. I think the answer is simply it was the poster child for migration in. It created this buying frenzy. Now that that is dying down, there's more supply. That seems like my best guess. But if you invest in Austin or Texas area and you have an opinion, leave a comment below. I would love to hear from you. How about the week ahead? There's a bunch of numbers coming up this week. We got home builder confidence, which actually came out this morning, which I haven't seen yet. But again, what are home builders thinking? My guess is, hey, rates are high. We're having to discount. We're having to buy down rates. They're still selling. I mean, look at the numbers, new home sales, but we shall see. Now, tomorrow, housing starts. Housing starts will be interesting because, again, I expect the housing industry to start contributing to positive GDP growth. The housing industry has been negative contributor to GDP for 6 or 7 quarters. I expect it to go positive, maybe not Q3, but maybe in Q4. Then on Wednesday, we get the Fed rate decision, pause. We get a press conference, hawkish pause. Then we get the economic summary of indicators. And I expect to look at terminal rate. It'll be very interesting. How many Fed presidents expect no more hikes and how many expect 1 or more hikes? I think it might be 60-40. I think they're going to lean hawkish. They want to keep the market expecting. But we shall see. Then on Thursday, we get existing home sales. Again, I'm going to call a shockingly low number at 3.85. Plenty of you have taken shots at yesterday's Nailed It t-shirt. That will be important. We'll get weekly unemployment claims. And then Friday we are going to get 3 Fed speakers, which will be interesting because, again, that will be after the rate decision. How hawkish are they? How dovish are they? We're going to start to hear on Friday. So let me give you some summaries. We did our day 1 boot camp yesterday with about 40 some odd individuals in attendance. Thanks each and every one of you. We went through, I don't know what was it, about 18 or 19 of you said, hey, I don't have a market yet. This is what I'm thinking. I want to tell everyone out there my 5 takeaways. My 5 takeaways. If you're struggling with not getting a market yet or you don't know where you're at, here are my 5 pieces of advice after yesterday. 1, I want to give you permission to slow down. I want to give you permission to say it is okay to learn a market. I am trying to help you learn a skill. Hey, Kip, thank you. How you doing, man? I appreciate that. It has been a while. So again, I want to give you permission to learn real estate investing. I believe real estate investing is no different than learning a language, learning a musical instrument, learning a new sport. It takes time and practice. So first, don't be in a rush. It is okay. I give you permission to take 90 days, 120 days. You have to do the work. You have to practice. You have to focus, but you don't have to be in a rush. Number 2, going from, hey, I'm excited. I got a buddy who buys a bunch of real estate. I watch this guy on YouTube. He's killing it. I want to be just like him or her. I want to buy something in the next 90 days. Folks, in my world, not okay. Not okay. I know there are a lot of folks who have dry powder on the sidelines. I know they have seen mortgage rates go up. I know they've seen price go up. I know you're feeling like you missed the boat. Folks, there is no line cutting in learning a language, in playing a new sport, learning a new musical instrument. Just because you have the money doesn't give you permission to jump the line. We don't do average deals if you follow what I talk about. I want you to do a great deal. That takes work. So if you have a goal, you have no properties, no network, no nothing, and your goal is to buy a property in the next 90 days, I'm not your guy. You're going to probably gamble. Ooh, my throat. 3, learning the skill of real estate investing is transferable. A lot of the folks we talked to yesterday, and probably a lot of you out there, are like, Michael, I can't invest in my backyard for whatever reason. I want to invest in this cheap city states away. Great. Awesome. I don't care. You still have to learn the skill of real estate investing. I suspect for most people, learning the skill of real estate investing is easiest, fastest, and most efficient in your backyard. I want to take you back to my story in my first book, One Rental at a Time. I should have made this more obvious. In hindsight, I should have certainly. One, I spent a year learning real estate investing. Every Sunday, we would look at real estate in the Bay Area. I was looking for cash flow, not appreciation. Complete failure if that was my goal of buying a property. But I learned the skill. So, I have the skill. I then go to Fresno, California, a market I knew no one, I never lived in, complete newbie. In the span of about 90 days, I learned the market, the network, and I took a shot. If I had to learn real estate investing and learn a brand new market, it would have been a complete disaster. Complete disaster. So again, sometimes learning the skill in your backyard is the right idea. Number 4, save time by learning in your backyard. Sometimes that is the right answer. Sometimes it's about speed and efficiency. And then number 5, the goal, the absolute goal of what I'm trying to help you understand with my course, How to Get Started One Rental at a Time, all of these other things is, hey, an average deal is whatever it is, X% yield, cash on cash. That is what you can learn by looking at your market, your buy box every day. Average. Once you know average, you can add a percentage for good and a percentage for great. I like 1.5 and 3, but you do you. So again, those are the 5 things I have learned from the boot camp. Our next session at the boot camp will be about the buy box. That is Saturday, 8 to 10 a.m. I've already sent the Zoom link to all the course members yesterday. So thank you for being there. And let's talk about the theme of the event. If you don't know yet, we are putting on the first live event for One Rental at a Time in Las Vegas, Nevada, February 17th and 18th, Saturday and Sunday of President's Day weekend. I've been putting together the schedule, the agenda, the speakers, and the theme of the event is really going to be focused on full-time employees. How can full-time employees start a journey to wealth? So, we're going to have folks like, this is the first announcement, Jason Pritchard and his wife, Jennifer. She goes by Jen. They are going to be our first speakers. They are going to go up as a couple and talk about their journey to building a big business or empire. But it starts with burning the bridges. Folks, if you haven't read Jason's story yet, go buy my second book, 15 Conversations with Real Estate Millionaires. It is quite their journey. And frankly, not something I would have done. Great story. So we're going to talk about how they talked about money, how they talk about stress, what was the kick in the butt, all of those things. And you will get to ask questions. That is how I'm doing this event so different. Jason and Jennifer will lay out something in about 15 to 20 minutes. Then you will get 40 to 45 minutes of Q&A. Microphones, left and right side of the aisles. You will get to ask questions and drive the conversation home. We will have a presenter around creating a side hustle around your passion or hobby or interest. We will, of course, have plenty of real estate folks. It is going to be an event. We will also have, as I mentioned yesterday, Mr. Dan Bird is going to fly across the country and talk about stocks, and you get to ask him questions. This event is focused on full-time employees. There's about 100 seats left for general admission, $199. You get 20 some odd hours of content, ask questions, you get a concert and a party. VIP, we have 4 seats left. We've increased it from 50 to 65. You have 4 seats left. 4. Buy it today, they'll sell out today. General admission, $199. Sign up. You will enjoy it. You get to ask questions. Bring your significant other. Ask all the questions you would like. I hope you enjoy it. Folks, take care of yourself. Have a wonderful day. I need to go get some water for this very, very dry throat. Bye.